6.5% to 7%. Depends on what kind of loan you get, whether it is SMSF, trust, or the personal. Yeah. And now the property prices have gone up significantly, that the amount of gap between
portfolio itself, and it is allowing him to be able to sustain what he's got and to be able to hold on to what he's got, because it's important. The holding costs are a very, very important factor when you're looking at a property and cash flow.
But there are better locations where the market's undersupplied.
Yeah.
There are locations where affordability is still better. The locations where you could see buying and renting affordability is good, and then population is more than 9 to 10,000 people.
Yeah.
And then because of the diversified employment, it is attractive. So now you need properties which will grow in capital value. You need a properties which has good rental yields to balance your portfolio. That means you can't just buy a property which is having a capital growth and not good cash flow. So that means you need to have a mixed approach.
Yeah.
You should buy in a pairs where...
Welcome to the Property Portfolio Podcast, where property, finance and investing are broken down into real conversations, which have benefited thousands over the years. The show is hosted by leading industry experts who bring different strategies to the table. Parag Dixit, Chief Strategist of Infinity Financials and Prop Wealth, has more than 20 years in the financial industry and is consistently ranked among Australia's top 10 mortgage brokers. Rudit Khandelwal, Director at Infinity Financials, has 2 decades of experience and over 200 5-star client reviews. He's known for helping clients build strong property portfolios. Julius Dabre, co-founder of Prop Wealth, has spent more than 15 years in real estate domain. He is a lead data researcher and has helped hundreds of people create wealth through property investment. Subscribe to the channel and get regular updates on what's happening in the property market.
The information in this podcast is of a general nature and does not constitute financial or legal advice. It has been prepared without taking into account your personal objectives or financial situation. Individuals must not rely on this information to make financial or investment decisions. You should seek independent professional advice before acting on any investment decisions.
Hi Julius, how are you?
I'm good, Parag. How are you?
I'm going very well. Thank you very much. How are you enjoying the post-budget blues?
Yes, different strategies, lots of different kind of properties we are buying, lots of different questions.
Lots of changes, lots of questions.
Yes.
And that's why we are all here. Welcome guys. Welcome to our brand new podcast. We will be discussing why affordable and positive cash flow properties are now becoming important again. Why people are vying for that. We'll take you through why investors, they're ignoring all these cash flow positive properties for all this time. But higher interest rates, holding cost changes have now changed the debate between capital growth and cash flow investing. Which kind of suburbs are investors talking? We'll talk about that. Loan strategies, what new investors are thinking, what are they thinking differently from others? And then obviously we'll touch upon at the end of, is the landscape changing forever now with this new budget and all that stuff which has come up. But all right, okay, let's get on to it, Julius. What do you think? Investors really ignored cash flow for all these years, right?
Yeah. So when the interest rates were okay, when you compare between 2021 to 2023-4, multiple scenarios. So during pre-COVID, it's around 4%.
Yeah.
Property prices were not that great. Yields were okay. So lots of people were investing in Sydney and surrounding. 22 onwards, a lot of options have opened. Like a lot of people start buying in Perth, Adelaide, Brisbane. Over there, the property prices are in mid-4s to 500s. In very good suburb, it's 600,000. Yields are more than 6%, interest 4%. Lots of properties were positively cash flowed.
Correct.
So only agenda was to getting into high capital growth investments.
Correct.
Yeah.
Correct.
During COVID, the interest rate suddenly went down. Property market have gone up immensely high in a lot of pockets and across entire Australia. So investor had a choice. Okay, the cash flow was not an issue at all.
Absolutely correct.
Because you still have a lot of buffer. Your expenses for the properties is lower because the major cost to hold the property is interest, plus all your other cost. But the major cost was not that high because of the lower interest rate. And then expectations was getting it towards the higher capital growth properties. When interest rate started rising, still there was a hope that they'll go down, and property prices were moderate for the last 1 to 2 years. With interest rate rising, the supply was lower, demand was extremely higher towards the property market. And then what we've seen is property prices have gone up significantly.
Yeah.
So there's a situation where property yields are close to 4.5%, but interest rates are around more than 6%.
6.5%, 7%.
6.5 to 7%,
Yeah,
depends
yeah.
on what kind of loan you get, whether it is
where you
SMSF,
stand.
trust, or the personal. Yeah. And now the property prices have gone up significantly, that the amount of gap between the yields is significantly higher in a dollar value.
Yeah, correct. Yeah, you're so right. So when you're talking of an interest rate of 2%, 3%, then even a 4%, your rental yield is good enough. It's covering my cash flow, even some kind of cost also it covers. Doesn't bother me, doesn't impact my lifestyle. That was my old investment property mindset. I'll get, even if it does, but I'm getting negative gearing, so it chuck it away into the tax return. It takes away some of my income. Some part of it comes back from the income tax. So I'm fine with it. I'm happy keeping my rents lower. Let the tenant be happy. You $20, $30, you don't bother about it. So you're all good. You're looking at long-term appreciation. You wanted capital growth, and capital growth was the objective because cash flow was a given. You never have a problem with cash flow. Everything was fine. That's why, in those low rates, when you're at a 2% rate of interest, a 3% rate of interest, before COVID, we were used to be around 3.5-ish rate of interest.
Yeah.
That's fine as well. It was not earth-shattering when you have a 3% or 4% rental yield properties. You're all good. But it's changed now. The post-budget scenario is completely changed now. It is now you're sitting at a 7%, 6.5% interest rate, 3.5%, 4% rate of interest higher than what it was earlier. 4% on $1 million is 40 grand. That's a lot of money. 3,500-4,000 per month. That's an impact if you got one property or a loan which is about $1 million. That changes the dynamics for you. That changes the dynamics for how investors have started thinking. Okay, they say, all right, okay, there's an amount of money which I can put in from my salary, from my income, from my business income, and now there's a limit. I don't want to cross that limit. And now there's a point which is coming where investors are saying, okay, do I now start looking at cash flow as equally importantly as I used to be taking care of it earlier? It's now the new budget is kind of kicked in that thought again. That, all right, if you can't negative gear in your regular income, and you have to accumulate that negative gearing over the years, then do I look at it differently when I don't have that tax refund cash flow support which is going to be there for me? And that changes a bit, specifically with these high interest rate scenario. When I'm looking at a high interest rate scenario, I would always look at what is going to be my outflow and what is going to be my inflow, because a lot changes. There's not only interest rate, the interest rates are there, my property holding cost tremendously increases, and if my rental yields are not rising to the extent which your interest rates are rising, or if my rental yields are stable at where they were, or they are going down because, like you rightly said, property prices have gone up, my newer property, my rental yield is going to be lower, my gap keeps on increasing. And when the gap keeps on increasing, I'm saying, how long do I sacrifice my lifestyle to afford a property? And that becomes a discussion point for investors to look at what to do.
Yeah, that's right, because net dollar loss is higher, and then amount of prices, it's gone up from last 4 to 5 years. That amount is even significantly increasing.
Yeah.
Second thing is there's a great hit on buying and renting affordability.
Correct.
So renting affordability is at the toss. That's why, because rentals were growing from longer time, and now there is a limit for the rentals. Even though there is extremely lower supply for the rentals, still there is a renting affordability limit.
Yeah.
In a lot of states, that's already been hit. So you can't see a rental rises, but still the expenses towards the properties are increasing.
Yeah.
And then the last bit was, there was a little hope as a negative gearing, whatever the net loss you're doing, still the investor can claim those negative gearing benefits. Now, from July 2027, probably you're not going to use it. So the net negative is still higher, and it is going to be higher for a longer time. So that's why when we look at the portfolios, right, I've seen with the investors, there are different kind of portfolios. There are portfolios which are pretty weak, where I had a client who was holding a property in Sydney he bought it during a lower interest rate, around 2% scenario. Yeah. During that time, his negative was close to $1,000. And then now at the 6%, probably he'll be spending around 36 grand a year on a single property to hold in Sydney. That's not only impacting his daily cash flow, but it's impacting his borrowing capacity, as well as he's not in position to buy next property. That means just because of one property, he's not able to either sustain that entire portfolio, or he's not able to scale the portfolio.
Yeah, plus if you get into it, some kind of unknown expenses which come in, any kind of maintenance which comes in, or you need some money for your personal stuff to go for a holiday, to go for a trip, to do something in your owner-occupied house, you're kind of stuck. You know, how much cash, because there's a cash-sucking machine which is put in there, and then it's troubling you all the time, right?
Yeah, it is. So that's why it's a personal cash flow crisis versus your entire portfolio is stuck because of the wrong selection of properties.
Yeah.
Because previously, what a lot of investors used to do is, okay, I'll go and buy property in my backyard, like go in Sydney and buy. Because the interest rate was not that great, it was on the lower rate, there is a bit of affordability, which we changed. But I've seen the people where they have balanced their portfolio well as well.
Yeah.
Few clients where they hold more than 8 properties, few are high capital growth, where few are well balanced between the cash flow as well. So in this entire scenario, the behavior of the investors are changing from holding a high cash flow, from holding high capital growth property, which are severely negatively geared.
Correct.
Which is very, very hard to hold at this scenario, versus they're going towards the more balanced kind of portfolio.
Stronger portfolios.
Yes.
Yeah, correct. I look thinking about a stronger portfolio. In fact, I know when we were doing mortgages, I know someone, he's got about 10, 11 properties, and a lot of these properties have a good balance. So he's got a couple of granny flat properties which are having a positive income. He's got a couple of properties where the rental yields are about 6.5%. He's definitely got a couple of properties with about 3.5% rental yield. But what he's done is he's brilliantly managed the portfolio in a way that each property is able to take care of the other weaker one. So a balanced portfolio, a very strong portfolio has been created in this manner, in which someone is saying, okay, even if I have something which is going to give me a large capital growth, and I want to have that because I'm going to earn my wealth from there, I'm balancing it with something which may not have that large a capital growth, but it has a high cash flow which is coming in, and it's balancing that bit out. Then hence the cash flow impact on that portfolio is taken care of within the portfolio itself, and it is allowing him to be able to sustain what he's got and to be able to hold on to what he's got, because it's important. The holding costs are a very, very important factor when you're looking at a property, and cash flow property investment, positive cash flow property investment really takes care of those holding costs. It's dangerous. Holding costs can become very dangerous for people when they suddenly come up, because besides interest rate, we're talking of interest rate, but besides interest rates, you'll have council rates, you'll have land tax which comes in, you'll have insurances, you'll have government levies. States like Victoria have got a large government levy which is coming in. I heard that NSW is also planning to put a government emergency levy on the people who have houses. Maintenance can be large, right? I've seen people who've got various kind of maintenance bills and issues which have come up, and you can't do much about it. If they come, and those investment property, those holding costs for the investment property become troublesome if they go out of proportion, and you already have a higher rate of interest in the regime which is going on, and then you have this that brings more and more cash flow problems. With more and more cash flow problems, you will start becoming weaker and weaker in the portfolio which you carry. When you are weaker in the portfolio which you carry, any kind of a vacancy, if it hits you, that's a double whammy. Then you're not able to manage it. You've got too much of a pressure on you. One, you're already negative in cash flow. Then you don't have rent coming in. And even if you have rent coming in, you get desperate. You may lower down the rent, or you may not get the rent which you want, or you not get the quality of tenant which you want, and it starts bothering you more. So it's an unending cycle which you get sucked into, which doesn't really help you out somewhere and give you a benefit there.
Yeah, correct. So that's why a lot of investors are feeling pressure now, because multiple rate rises had happened. Then when interest rates are rising, then actually it gives you it will not give you more leverage towards your entire cash flow. That means there is a lot of impact on your cash flow. So that means you're reducing your savings, plus then it impacts on your cost of living as well, because the inflation is rising, so everything is expensive. It's further eating up your saving. I've seen a lot of investors have over leveraged.
Yes.
So in between, there was a phenomena that a lot of people were buying properties under the trust. So like due to the bad advice, a lot of people have bought properties under multiple trust. Each trust, maintenance cost for each trust, so much of negative. There are a lot of people I've seen that, okay, sometimes you have to balance your portfolio with the good kind of properties as well. Like few properties should be good. Few property could be older property, will have a good land size where in future you can put the grannies. But sometimes those properties are very, very difficult to hold because they're very old properties.
True.
So I've seen investors who are only buying this kind of properties under the trust by saying, okay, in future I'll put the granny. But now suddenly if you have any cost to repair that house, that's an additional expense. So that's why, because of the over leveraging problem, because of trust, because anyhow you're hiding, right?
Which have got into
Correct,
it.
So you are reusing your borrowing capacity in multiple times, and then but you still have to pay that money.
You still have to pay the cash flow gap.
Correct.
And that's where it becomes troublesome. And let's not forget, building costs have been rising, so maintenance costs have been rising as well.
Extremely
tremendously high maintenance costs right now. Anything it's easy to spend $500,000, and that's not easy for everyone to spend in a particular month, and that makes it very, very bad. And that's why one of the most important aspect of managing the dangerous holding costs is to have a buffer with you.
Yes.
You need to have a buffer if you are looking at investing, and if you are looking at having a property which is negative, and that brings you more and more comfort if you've got a good amount of buffer sitting on the side, so you know you're not going to have monthly problems. But again, you're dipping into your savings, which is what is the problem, because when you're dipping into your savings, you are finding, okay, I'm kind of stuck. What should I look at? Do I re-look at having a strategy which is a capital growth strategy, which I was been carrying as a legacy, or do I look at a newer strategy which is more cash flow positive strategy? And it keeps on bringing me a question all the time that capital growth was nice, but I am not able to afford the property. How long do I wait to encash my capital growth? Do I encash it now and then invest into something where I would get a good cash flow and maybe get a couple of properties like that which give me good cash flow so that I can get my lifestyle back? I don't want to be just feeding a property. I just want my lifestyle back as well. And hence, do I rebalance my portfolio by looking at, okay, I've got 3 or 4 properties or 2 properties or 5 properties. Okay, this one is the biggest draw on cash flow and it may or may not be rising at much. So let me just put this one out and get a positive cash flow property in. So it completely changes my scenario. I may not need to do too much to do that. Maybe one property out of the whole portfolio can change the way I look at, or I don't know whether can I have both, in the sense of I get 2 properties out of what I'm selling and then I'm able to get better benefit out of that. Can I have a more positively geared portfolio itself, which allows me to generate wealth for me in terms of my cash flow in a year and also growth in the longer term.
Yeah, that's right. That's why I can see a lot of investors are trying to rebalance their portfolio now.
Yeah.
Because of the fact that most of the investors, when they are building their portfolio, it's not thoughtful portfolio that, okay, a lot of people were just looking for capital growth perspective where not a lot of investors are looking at higher cash flow properties.
Yeah.
So, but now the current scenario is basically the interest rates are rising, affordability is tough.
Yeah.
And still, whatever the incentive you're going to get it from the government, they are going to be stopped for the property which you're going to buy next. That's why the rebalancing of that portfolio is very important.
It is very important, and that's very critical, and that always brings us to the point that now with this new world, with this new budget and all this complete revamp of the way investment landscape is in Australia, what kind of suburbs would you think that investors would now be targeting? What kind of suburbs do you think they would be looking at? What are the factors where they would be looking at to invest now?
Yeah. So now the current landscape of investment is changing. So at this stage, a lot of investors can either afford a little bit of negative gearing or close to null, and then borrowing has a lot of impact as well. So there are a lot of suburbs who are still offering the property prices are in between $300,000 and $500,000. And that's where the most of the affordability is rising. Plus, that's where most of the property investors can afford to buy properties.
Yeah, correct.
So wherever the rental yields are more than 5%, because your interest rate would be very close to 6 to 6.5%.
Yeah.
But if you're buying something at around 5 to 5.5% with $300 to $500,000, then out-of-pocket expenses won't be extremely higher.
Yeah, just a few hundred a month.
And then there are a lot of suburbs are still available.
Yeah.
Doesn't mean that you go blindly and buy anything in Australia, right? Because you could find more than 1,000 properties of such. But when you're getting into this type of properties, then you have to be very careful about how to select those suburbs properly.
All right, that's very important, right?
That's very important.
Because not every cheap property is going to be a great property.
Correct. So that means, yes, I would like to get into a property which is $350,000 to $400,000.
Yeah.
But then what kind of data I should look at?
Yeah.
That is very important parameter, research.
Yeah.
So like for an example, there are suburbs where only 1,000 people are living.
Yeah.
You can still find a property for $200,000.
Yeah.
And you could see the rental yields are higher. The gross yields are higher. But when you look at the council rates, when you look at the tenant quality, when you look at the vacancies sometimes, when you look at if you want to get a trade, it's so expensive that your net will be extremely lower.
Yeah, absolutely.
And even though because of that area doesn't have a good fundamentals, then you would not see that, okay, the property prices are rising.
Yeah.
So in that, when you're looking for this type of properties, certainly you are getting into regional locations.
Yeah.
But there are better locations where the market's undersupplied.
Yeah.
There are locations where affordability is still better. The locations where you could see buying and renting affordability is good, and then population is more than 9 to 10,000 people.
Yeah.
And then because of the diversified employment, it is attracting a lot of people.
Yeah.
So that means you have a rising population.
Yeah.
Vacancy rates are extremely lower.
Yeah.
Demand is higher. That means you will have a constant tenant demand.
Yeah.
And also because of the higher population or population growth, your rentals are rising, which creates the additional demand for population growth as well as the property price growth.
Yeah, and it allows, there's a good point, because because there's a good population, so there's an economic activity happening there, so people are earning well, so that rental yield is sustainable.
Yeah.
It's not that because of somebody came, because he had some work for a few months, so he gave you a higher rent and then he moved away, and then you're back to where you started from. You have a continuous rental yield which is going to be at a similar point or growing. So as an investor, you would look at areas which is a mix of all of this and affordable as well. That's most important, that I can afford a property there. There is a good demand out there. There's a good rental yield out there. It's a sustainable property there, right?
Exactly. So it's not always necessary that it has to be capital city.
Yeah.
But at least it has to be either close to a significant urban area.
Yeah.
Or that area should have at least a good employment opportunity where it's not dependent on a single employment.
Right.
Where risk of that employment can have a lot of job losses.
Yeah.
And probably it will have a bigger impact on the property prices. We should not get into properties. Cheap means you can't go and buy anything. You need to select the right asset.
Yeah.
Sometimes you find properties which is on the stump or subfloors where property is too old, like 100 years old, required a lot of maintenance, bathroom required maintenance, properties as asbestos. So asset selection has to be very good. Like, okay, when you buy a property, when you select the suburb or region, then probably type of property should be at least a good weatherboard or a brick home. Should not be like, okay, if it is 40, 50 years old, should be fine, but should be in a good condition. When you do a structural inspection, when you do a visual inspection, then property should have a good tenant demand so someone can come and live there. So it's not always necessary that go and buy any property which is available in the market.
Correct.
Rather, selection of that good properties, selection of good area, selection of good tenant, it's very, very important as well.
Correct. 100%. That is very, very important of what kind of area it is there. Cheap is not good all the time.
Correct.
Cheap can give you high maintenance. Cheap can be so far off from trades, like you were saying. Cheap, like it's a lot of mining towns you find cheap, but some mining towns have gone crazy in terms of the price range. Yeah. But some of them you find it cheap. But that place, God forbid, if there's a maintenance which comes in, that it's practically impossible to get somebody to come there and do some work there. So cheap is not great. Cheap may not give you a long-term price rise. Cheap cannot give you something continuously higher or good for that. Yeah.
Yeah. So long-term growth is also very important. It's just not about the short spike.
Yeah.
So always focus towards the asset selection as well as the long-term growth.
Yes, correct. 100%. That long-term growth is most important, because if that long-term growth is not going to come in, then you don't like investing. Then what are you there? What are you doing that for? You want to balance both of that, but if long-term growth is not there, my attraction is not there. But if my cash flow is not there, I am not able to manage that.
Correct.
And if I'm not able to manage that, then I get into trouble. And that's where, when I was talking at the earlier times, loan strategies have also become very important right now. In terms of a loan strategy, I mean that, okay, what do you want to do? How do you want to structure your loan? Whether the cash flow is kept intact by taking an interest-only loan, whether you, in these high-rate environments, whether you have a mix of a fixed and a variable rate loan, whether you are looking at a good rental yield. So you start off with saying, okay, I want a 6% rental yield, or I want a 6.5% or a 5.5% rental yield. So it keeps my borrowing power intact. It gives me a full round structure and a strategy on how do I plan out my portfolio, so that whenever I'm looking at doing any kind of an activity, whenever I'm looking at my whole portfolio in itself, I find that, okay, I am pretty well off. I am not too stressed off with what I'm doing, and I'm not too much of a issue. So when I'm looking at a loan strategy, I always look at how we are going to do that. And that's why younger investors are now thinking differently. They are saying, okay, my property strategy should have a strategy in it. It should just not be something which we have just thought of. I want to know where am I going to invest. I want to know the data which I am going to be there. I want to have a good loan strategy worked around it. I want to have a proper long-term plan, because right now the way it is investing, it's changed away from there. It's not I just buy anything which is available on the online platforms. I go and buy something which is data backed. I go and buy something which has a strategy. I go and buy something and hold it for a longer period of time. I want to have a sustained longer portfolio, because right now the taxation laws which have changed, they don't sustain something which you can buy and sell tomorrow. They sustain something which you can hold for a longer period of time. The taxation strategy now tells us that I should have a portfolio which is more long term. So my chances of doing a mistake today are not there, because if I do a mistake, I have to hold that mistake for such a long period of time that it's a whole new bunch of problems which is getting me. It's getting me opportunity cost, which I'm taking a hit on. I'm taking a hit on the growth. I'm taking a hit on my wealth or whatever plans which I'm doing, and I'm taking a hit on the cash flow as well. And it becomes a problem. So that buy and hold strategy is something which is coming into new investors' mindset very straight away. They don't want to buy anything under the sun. They want to buy something which is defined through smarter investing. They want to define something based on yields and demands and buffers and research focus, right?
Because we had seen a time when you buy anything and then it's growing. That's number one. Because the market was in a good market cycle timing, and that is across Australia. It's not only in one market. Then we had seen a time when there was a lot of government incentives were available.
Yep. True.
That to help you to grow your portfolio. So, but now the time has changed. So now interest rates are higher, affordability has an issue, borrowing capacity have an issue. Then government incentives are going to stop.
Yep.
So now a lot of investors, now this is a time when you just research before you buy. You need to know what you're going to do, how you're going to achieve, what kind of strategies you're going to use, what are your objectives, and to meet your objectives, how exactly you're going to approach and what kind of assets you're going to buy.
You're absolutely right. People are very focused on the kind of asset we are going to buy, because you want to now hold it for a longer time. And when you want to hold it for a longer term period, a cash flow positive strategy or a cash flow neutral strategy at the worst is becoming more and more critical now, because that cash flow positive strategy is going to let me enjoy my lifestyle and also hold on to the property for longer, property for a much longer period of time, which allows me to get the gains, allows me to be there with the way it is happening, and allows me to be more realistic with the market which I am now in, right?
Yeah.
And that's why it is a completely changed landscape, I suppose. I think it's changed forever now with these new taxation laws and the new trends which have coming in, right?
Yeah, so trends are a bit different now. So we had seen a time when a lot of markets were in a boom cycle. Every market was growing. There was a good cash flow. Interest rates were dropping. Now when you see the trends, a lot of regional markets are undersupplied. Now there is a lot of focus going towards the regional markets.
Yeah.
Because of the fact that, affordability changed. because of the fact that borrowing capacity have changed, because of the fact that that's where, a lot of investors can go up to and afford to hold properties. So that's why when you look at the properties for next 2 to 3 years, when rentals are rising in capital cities, yes, there will be time when people will move towards the capital cities as well. But now, if you want to buy something at $800,000 and $900,000, where the gap between your cash flow will be around $3,000 to $4,000 or $2,000 to $3,000, at this interest rate scenario, at this affordability, it's not affordable. And not a lot of people are able to achieve that kind of borrowing capacity because of the change in scenario. So trends are more towards getting into the affordable section, getting into the SMSF kind of strategies. See, so this is kind of a future of the property investing.
100%. This is the kind of future of the property investing. Balanced portfolios, very sustainable portfolios.
Yes.
That's the future. My portfolio cannot be so lenient, so dependent on cash inflow all the time. Correct. From my side, from my savings, from my this thing. It's not going to work out, right? It is to be more strategic buying, which I'm getting into. It has to be a resilient, long-term portfolio, which I am wanting to do. It's no more, like you said, lazy investing, easy investing times have all gone away, right?
It's gone. All the capital cities have grown. Yes, there are a lot of opportunities still available. But in that case, your borrowing and cash flow will not support.
Yeah.
If you're on a scale and if you go into the extremely higher negatively geared scenario, then you can't scale. If you go towards the affordable segment properties, then you can do mistakes as well. Then research has to be precise. So now, to make a portfolio, you need to have a different strategy. To get a portfolio, you need to have a good borrowing capacity. You need to retain that borrowing capacity. To find the right property, you need to have right research. So it's a bit difficult and it's more kind of research oriented. It's more scientific now.
And that will bring on even more focus to getting advice from your financial planner, from your professionals around you, from your accountant, from your buyer agents. I think buyer agents' role is going to become even more important, more evolved. I suppose buyer agents will also have to evolve into becoming more data focused, more scientific, to be able to give out research which is authentic. And their data sources, where are they getting data from and how they are analyzing, will become even more important, because a client now needs, before a person now needs, an investor now needs more strategy into it. They need more long-term investment. They need to see the future of the property to be secure, and their future also to be safe. They want high, good cash flow properties. They do not want cash suckers right now, right?
Correct. So now you need properties which will grow in capital value. You need a properties which has good good rental yields to balance your portfolio. That means you can't just buy a property which is having a capital growth and not good cash flow. So that means you need to have a mixed approach.
Yeah.
You should buy in a pairs, where you buy one property of good capital growth, another property of good cash flow. Arrange or buy properties where, should not buy all the older kind of property where you require a lot of maintenances, because you need to get a lot of money as well. So buy good quality properties, buy older properties which will have a granny potential. So in future, you can withdraw equity, put additional dwelling and improve your cash flow. So this is mix and match is very, very important.
Mix and match is important. Buy dual income properties, buy properties which have something nicer nearby.
Correct.
So it grows in value. But again, the whole mix of your portfolio becomes extremely critical now. That mix has to be right. This mix in terms of even structure has to be right. Which states you are buying has to be right. What kind of costs, which are holding costs, are going to come in has to be right. So that it brings down to the fact that your strategy has to be spot on.
Correct.
You just can't pick and choose and buy something, and that's where cash flow is going to become even more and more critical in these times in the future times to invest into, right?
Yes, correct. So cash flow is important, strategy is important, right research is very, very important, and right asset selection is very important.
Absolutely fantastic. No, I think very well summarized, Julius, on that part. Thank you very much for coming in today. I think we had a wonderful session.
Thanks a lot.
And let's connect again for something new.
Yes.
Thank you.
Thank you.
We hope you enjoyed the podcast. If you enjoyed being part of our community today, please take a moment to rate and review the show on your favorite platform.
We don't want conversation to end here. We're all active and ready to chat.
You can connect with each one of us directly via the links below. Thanks for watching. Keep listening. We have a lot of podcasts. Share your thoughts.